The S&P 500 rejected hard today. And in this video, we are going to be talking about what has to happen going into tomorrow's session and into the last week of November if we are going to get a rally into the rest of the year. Because if these supports start breaking, I think there's a very good chance that we could see the S&P 500 sell off another 5%, worse comes to worse. Now, before we get into the technicals and the exact triggers and things that I'm going to be doing with my fund, I first want to talk about the psychology of trading and investing, because I can talk until I'm blue in the face with you about my trading strategy and about what makes us take a position. But if we cannot stick to it long term because we're using improper risk management or psychologically we just can't cope with it, then all of the information I give you each and every single day is useless. I posted this earlier on X. I said that everyone says drawdowns are normal. Cool. But what does that actually feel like? This is why 90% of traders fail. If you cannot stomach the swings, the doubt, the pain, the questioning yourself, then you're not going to make it long term. And if you can't make it long term, then you can't stick to the strategy long term. And if you can't stick to the strategy long term, then you will never actually make a profit long term. And the biggest thing that I think so many people miss out on is the fact that all of the ups and downs that you see within your fund or within your strategy, including mine, is not an error. It's very simply just a part of the process, and it's a part of the game. I would love to not deal with drawdown, but it's a part of the game. I would love to not have to pay as much taxes as I do, but it's a part of the game. And if you're going to play the game, then you have to give and take. And so the first thing I want to say before we move on is that you have to stay in the game. You have to stay in the system. You have to let the math work long term. And this is where traders are made. Anytime things get hard in the market, I try to think to myself that this is what hard feels like. And this is why so many people quit. Now, in this video, we're going to be talking about the S&P 500. We're going to be talking about the market and my strategy, but we're going to be talking a little bit more in detail about risk management and how you can make these losses hurt less. And more importantly, how you can treat your fund like a professional going forward, because professionals, they don't care, right? Hedge funds don't care about pullbacks. They don't care. They're not even trading their own money in most cases. So they don't care about the ups and the downs of the market. But most people who are watching this are trading their own money, are trading for their own retirement. And I want to share how I do it and how I emotionally detach myself the best that I can. Now, the very first thing when we are trading within our system is going to be the core philosophy that if the monthly BX trender is showing buying pressure, then we will be able to make money with any strategy. So what we should be doing is focusing on what that monthly BX trender is doing and what is happening in the market from a macro perspective. Anytime I look to take a position, whether it's the S&P 500 or whether it is any stock, I want to first know, is there buying pressure on a bigger time frame? Now, in order to do this, we simply can just zoom out to a monthly time frame and take a look at the BX trender. Now, what I am looking for is the BX trender to either be increasing, so showing light red, or best case scenario, to be green. This is an indication that buyers are entering the market, and we don't want to be trading when that monthly BX is red. So if I were to go down into my strategy tester and see how this would perform with the S&P 500 over the past 24 years, you are going to see that just following this monthly strategy alone, we would have ended up making about a 653% return buy and hold versus 366 just buy and hold on the S&P 500. So our strategy of just doing that would have beaten the S&P 500 over the past 25 years. Now, throughout that time, we would have had a max drawdown of about 14.9%. So once again, no matter what happens, we're going to lose money, and it's going to be a part of the game. You're going to see that our win rate would only be about 43%, which is less than a coin toss. Now, the reason that we can be so profitable here is simply because when we are actually right, which is 43% of the time, our average win is 28%. And you'll see our average loss is 2.85% with an average risk versus reward of 10 2, 1. Now, I want you to not just think about this as trades, but I want you to think of this basically as a macro bull trend. Because remember, if that monthly BX is green, then it means there's a very high chance that we are going to see the market break out over a 10-month period. Now with that, if you want to get access to all of the indicators that we use in these videos, as well as learn how to implement them within the strategy, go ahead and check out the link to our trading library down below. You'll get access to the BX Trender, the Smart Money Mastery and Smart Money Zones, and the volume profile. Each course shows you how to actually set up the indicators, the proprietary settings. Over 20,000 students have implemented this into their trading system and are seeing consistent profits from as low as $10,000 all the way up to over $3 million. The link will be in the description. With that in mind, let's zoom out, take a look at the chart for the S&P 500 with this strategy in place, and first look at where we currently are. You will see that as of right now, we are in one of these bullish cycles. You can see that we would have gotten an entry here at the start of June this year, 2025. And the reason for that is because the month prior, the month of May, closed higher low or increasing. And as we said before, the average one of these bull cycles lasts 10 months and normally breaks out about 28%. Now, of course, since that is the average, there are going to be times where that breakout lasts even longer. Here we had a bull market rally from 2023 all the way up to 2025 that lasted about 2.5 years, longer than the average 10 months we just talked about. There was back here in 2020 to 2022 where we had a 2-year bull market once again. And of course, you can see there are plenty of times where this indication was wrong or the bull market lasted for a very short period of time. But going back to even 2009 and 2012, you can see that most of these bull market rallies last at least 1 to 2 years. Now, one of the things many people say, and they're not wrong because I started trading in 2015, is that I have not been a part of a bear market. Now, 2022 was considered a bear market, but I don't necessarily consider it as a market crash. So let's see how we would have performed back in 2008 and 2009, as well as the dot-com bubble using this framework. You are going to see here that we would have ended up removing our bullish thesis on the S&P 500 in December of 2007. So yes, we would have taken a small loss here of about 2.89%. Price would have continued to sell off. We would have entered or tried to time the bottom again in May of 2008. We would have taken a 10% loss. So these two losses back to back are about a 13% drawdown. Now, for some of you who are new to investing, you might be like, oh, 13%, I don't want to deal with that. First of all, that is nothing. That is completely fine. Second of all, look at what the actual drawdown was if you held the S&P 500. From highs in October of 2007 to lows of March 2009, your portfolio just holding the S&P 500 would have lost 55% of its value. So the fact that our worst case scenario was a 14% max drawdown and the S&P 500s was a 55% drawdown, I would be very, very happy with this. And this is why this framework is so important and why I trade based off of it. Now, let's look at the dot-com bubble. Same deal. We would have not been in this from September and October of 2000. We would have tried to time the bottom here in June of 2001, would have lost 2.5%. We would have tried to time the bottom again here in December of 2001, we would have lost 5%. And once again, we would have had a drawdown. But if we look at that period from September 2000 to lows of February 2003, I would way rather take the 7 to 8% drawdown on the S&P 500 that our framework and system would have given us versus the 44% drawdown that the market would have given us. And you can see that once that bottom was actually found, we got a 25% rally, a couple months of sideways chop, and then a 13% rally. So overall, this framework and this idea will keep us out of these bear markets. And yes, we will lose trying to time the bottom, but once we finally ping it, that is where our massive profits start to bake in. And so I want you to notice that just even looking at this performance history of this strategy over the past 20 years on the S&P 500 alone, though this is a very healthy equity curve over the long term, there are plenty of times that the market pulls back and that our fund pulls back. For instance, you can see even here in 2018, if you were trading just the S&P 500, which I want you to understand, I'm constantly trading this strategy across 40 to 50 stocks. But if you were just trading from 2018 to 2020, your portfolio would have sat sideways. You would have made no money for close to a year and a half. Some profits, giving some back, only to grow your fund nearly double from 2021 to 2022. Once again, from 2022 to 2023, you would barely have made any money. You wouldn't have lost anything sizable, but then once again, to grow your fund from being up 400% to 650% within that time frame. And of course, those numbers are compounded. So I want you to understand that if you are trading, and what I tell my students all the time within our framework and in our Discord community, is that you need to have a long-term focus when it comes to your trades and your investments, right? Because the edge that you have is going to come from the consistency of your system, not perfect entries and perfect exits. The whole goal here is to think about yourself as a long-term investor that's trading a system. I personally don't just buy and hold stocks because, as you've seen here before, dot-com bubble would have killed me, 2000 would have killed me. Instead, what I do is treat my system. I'm a long-term investor in my system, and we're here to invest in that system long-term and to make money over the long-term period. Now, let's talk about the S&P 500 and where we are at this point. Because there are a lot of people, now that we're about 12 to 13 minutes into this video, who would want just my analysis on the S&P 500 first and foremost. And the truth is, I'm not going to give that because, number one, people who just want the quick answers are going to fail in this industry no matter what. If they don't have the ability to stick to it, to actually learn, to actually put effort into it, they're not going to go very far. And second of all, you have to understand all of the things that we're talking about right now before you look to execute a position. You are going up against the smartest minds in the financial industry. And more importantly, you're going up against people like me. And so if you're not going to take it as seriously as I have for the past 11 years, and if you're not going to put in the work, then you are screwed. So with that said, since I know all of you are still here, let's talk about what is currently happening on the smaller timeframes, because we know this bigger time frame, the monthly time frame, is still bullish. And in most cases, that means that each dip should be bought up. And in most cases, it means that the rally will continue. Now, before we do move into that smaller time frame, I want you to understand that the long-term model is still pricing in a bull market from now all the way out to May of 2027 and targeting the S&P 500 to hit $800 by the end of 2027. So as we said before, bull market on the big time frame still there. Now, with that said, inside of that macro bull market, there are a couple of things that we can normally look at as factors to show if that bull market is going to end early. The first thing that I have been watching for a very, very long time now is the market bias on the daily chart. Now, you can get access to the market bias, you can get access to the BX trender, you can get access to everything that we've talked about in today's video down in our free course library. The link will be down in the description. But this daily market bias is very, very important because it shows short-term trend. Now, what I'm going to do here is put on multi-time frame analysis, and at the bottom of your screen, all the way down below, you're going to see what the monthly BX trender is doing. And you will notice that the monthly BX trender right now is currently green. And even though it is showing a bit of a decrease, the fact that it's still green is very bullish and very strong. And I want you to notice that since it flipped green back here in May and pinged the bottom for the S&P 500, each and every single time that we have pulled back into this bias, we have bounced. And so this has been a very strong trend indication and a good sign that the rally is still going to continue. Now, you can even go back and look at October 10th when we had this significant pullback. You can look back here at November 7th when we had this pullback, and even most recently. every time we tap 660 and every time we hit that level, we bounce. Now, the thing that you have to remember is that as traders and investors, our goal is not to predict the market. The goal is not to come out here and say we know for sure what's going to happen. It's to react. And as long as our criteria is still met, our thesis stands. Because I would have expected the market to break this support back in October, but I kept my bullish thesis. Why? Because all of our criteria is still met. Now, today we had a very strong bounce. Price gapped up and we were trading right around 672 to 676. And from there, the market just sold off massively, continued to burn for the rest of the day. And I want you to understand that where we are right now is really a make or break moment short term for the S&P 500. And if we look at the next 6 weeks into the rest of 2025, this week and next week's session are very, very important because we know that the monthly BX is still green. We know that macro buying pressure is still there. But if this support level of $655 to $650 is broken, like fully broken, and this trend reverses, there's a very good chance that price is going to continue to sell off aggressively. Something to note here is that underneath of this level, if we look at this volume profile indicator at the side of your screen, which you can get access to for free down in the course library, we have a huge gap on this volume profile. So basically, when there is very little volume or very small blocks here to the right, it is very easy for price to sell off aggressively, or in the opposite stance for price to break out aggressively. And so when we look at this, if this support breaks, I really think the market's going to continue to burn. Now, the question will be, where will it sell off to? Now, in order to find that out, we are going to put on a weekly market bias. This is normally going to be the next support after the daily bias breaks. So think of this as rungs in a ladder. When the daily bias breaks, we normally fall to the weekly bias. And when the weekly bias breaks, we normally fall to the monthly bias. And you can see here, back in May, that's exactly what we did. Price pulled all the way back down, broke the daily, broke the weekly, and eventually bounced at the monthly. So if the daily fully breaks, which it has not completely confirmed just yet, but it's not looking good, then the next level that price will most likely pull back into is this weekly market bias, which means that we would have a worst case continued sell-off of anywhere between 3% to about 6%. And I do think that that would end up happening within the next 2 to 4 weeks, meaning there would be no Santa rally and there would be a market correction into the rest of the year. But the key thing to remember here is that the monthly bigger time frame is still bullish, and structure and support here on the daily time frame are still bullish. And so that means that until this level breaks, I am still bullish. It doesn't mean that I'm going to be right. Of course not. At some point, we all have to be wrong. And as I've showed you before, historically, we only have about a 45% to 55% win rate. But the most important thing when we are trading and investing is not necessarily your win rate. It is your risk versus reward. And you can see historically win rates for these types of setups are between 59% to as high as 75%, but it's all about the risk versus reward. How much money are we making when we are right versus how much money we are losing when we are wrong? And from a trading psychology standpoint, that is the number one thing that most of you need to get over. You should not be trying to avoid losses. You should not be trying to avoid being wrong. Your goal should be accepting those, using proper risk management, using proper position sizing, and continuing to move on and trade as always, and letting your long-term edge be your guiding light in the market. For instance, if we take a look at my current fund right now and all the holdings I have, my average position size for each one of these stocks is close to 2.5% to 3%. And so I'm never over risking or over leveraging. If a stock meets my criteria, I will add it to my ETF and I will add it to my fund and I will simply trade it. Whether it's a winner, whether it's a loser, it really doesn't matter. I hope this video helped. If you guys have any questions, go ahead and comment them down below. I know that this was a long one, but I feel that after this week and after this day, it's much needed. If you watch until the end, it truly means the world to me. You are not part of the 90% who are going to fail. Most people in this world have no discipline. They have absolutely no ability to stick to something for longer than a couple of minutes, especially if they're not seeing any types of results. And that fundamentally means that if you want the results of the 90% of people in life and in trading, which most of us don't, then you need to do the opposite of what those people do. And if you've made it here that long, then I know you're doing the opposite of everybody else. I congratulate you on it. Thanks for all the support. I'll see you guys next time.